Neeraj, firstly, thanks very much for taking time out to talk to us. Now, to begin with, most macro indicators that we are seeing are seeming to suggest that the current financial year is not going to be as good as maybe the last one. Is that something you'd agree with?
Broadly, yes, I would say so. I think in the last few months, most indicators have trended down. Our own house estimate, our economists estimate, we have revised it downwards, the estimate for the growth for GDP next year. Our estimate is now closer to 8.1 for the full year, and we are predicting that the first half of this year will be slightly slower, in fact at around 7.8. So there is some slowdown, definitely.
Sure. Now, when you say there is going to be a slowdown, should we expect that credit demand, now RBI has put out a forecast of about 20% credit growth for the current financial year. Should we expect that the banking system may not ultimately see that kind of credit growth and that you will see demand for credit slackening?
I actually believe that we will hit the 20% credit growth demand. So whereas your first question was right to say that there is a slowdown, but we must remember 7.8 or 8 or 8.1, whatever that number comes out, is not slow growth. It is only lower than what we were estimating earlier, which was closer to 9, and on the back of last year's first half especially. So when you look at 8%, let's say 8%, approximately 8% growth, and you talk about a high inflation environment, which is what we are in and we are predicting it to be, let's say that's between 8 to 10%, then you're talking about a nominal growth of 16 to 18%. If nominal growth is of that order, credit growth at around 20 will probably just about be on par and probably support this nominal growth. So in a high inflation environment, in fact, I would worry if credit growth slowed down significantly, that we would be able to meet the GDP growth targets that we have. And as I speak, and we are now in early June, we haven't seen a slowdown in credit in April, May, despite some months of data which has been showing that manufacturing activity is slowing down. If you look at the industry growth numbers, if you look at our own growth numbers, we're not seeing a slowdown in credit growth as yet, at least.
Right, but the fact that interest rates have gone up since March 2010.
That's right.
Up to now, the effective policy rate is up about 400 basis points.
Yeah.
And there have been various studies that suggest that for every 1 percentage point increase in interest rates, the SME sector stands to be hit the worst, where every 1 percentage point increase in interest rates tends to pull down their profits by about 14%. Are you beginning to get a sense from that sector and also the MME sector that rising interest costs are hurting their ability to repay loans?
You see, the borrowing cost rates have actually started to bite only in the last, I would say, 60 to 90 days. So the first phase of rate increase that the regulator did impacted more the deposits cost going up, whereas because there was liquidity in the system, the transmission into lending rates did not happen till early part of this year. So the effect is still recent. First of all, I'll qualify that. Secondly, I think in a high inflation environment, at least so far, we are seeing that the buyer is able to, there is enough buying power to buy at the higher prices. So there continues to be demand, and therefore there is manufacturing and offtake of goods happening. If consumer offtake was to drop, I would say I would start to worry. But consumption seems to be still quite fine. Now, nobody can argue that on a sustained high interest rate environment over a period of time, demand will fall, and demand will then fall. And if it falls, yes, it will impact the SME and the middle market segment more than it affects the higher corporates. So I would, as a bank, we are being cautious. We are watching this segment. So far, we haven't seen signs of stress in either our SME portfolio or middle market portfolio. But it is a segment which is traditionally more susceptible to high rates of interest, and that could happen.
But again, within this segment, the SME and MME segment, do you get a sense that many of them are delaying expansion plans purely because of the interest rate factor?
We started to see some signs. I would still say small, but there are some signs of some of our clients saying that they would phase out their investments in a manner which could, which therefore the high credit cost doesn't hurt them as much. But I would say if I was to look at any of the past projects, they are continuing full speed. I think it's more to do with announcement of new projects whereas people might decide to wait out a little bit before they start to launch new projects.
Now, focusing on large corporates which have the leeway to access global markets to raise funds, are you seeing an increasing trend as interest rate differentials widen between India and OECD markets, where these corporates are increasingly looking to overseas markets to raise money?
There is data to suggest that as well. I've seen some data that I think the RBI put out recently, and looked at the amount of ECBs raised to local debt raised compared to the same period last year, and the proportion there is greater debt being raised from the capital markets internationally than local markets. And this is despite the credit growth in India being strong. So the bank growth is strong, but the debt market raising and the capital market raising in India has been lower, and the bulk of that has shifted to ECBs and international debt capital markets. This is natural. I mean, because the differential is quite high, with the West continue to keep rates low, and most of the Asian banks now starting to raise rates, and India is in fact on the higher side of the interest rate cycle. So the differential is large, and fundamentally there is nothing wrong to capitalize on this opportunity for Indian corporates to raise cheaper funding from abroad. So we are seeing a trend. I mean, to answer your question in brief, yes, we are seeing a trend where people are raising funds more from international markets.
Sure, but while Indian companies are keen on going overseas and raising money, what's the appetite for Indian paper? Because obviously there will be a lot of concern about corporate profitability in India coming under pressure. Inflation continues to be a big concern. The current account deficit, the fiscal deficit, these are all matters of concern, I'd imagine, for banks subscribing to papers issued by Indian corporates.
You're right. I mean, the point is, and this is a matter of a lot of debate and lots of conversations all over the place of whether the India story, on the back of all the macro concerns around India, is it starting to look less attractive? I think the truth is that there is less change in the fundamentals and there's more change in the sentiment. But sentiment is important. I wouldn't deny that. So I think there is a change in sentiment about India. People are I would say, talking a little bit more about it than they did in the past. So it would probably on the margin impact some flows into India, and I think that we should expect. But the other side is that India fundamentally remains an attractive story, and a lot of people who are investing into India realize that, and to that extent funds are still coming in. So if we look at data, I think debt flows continue to be reasonably strong. Equity flows have been two-way, so we've seen that, and that's not just an India story. But yes, I think there is more debate than before around the story of India.